Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. It's a big week for the economy with the release of the CPI data for the September quarter yesterday. The Consumer Price Index measures household inflation, and on the Reserve Bank's preferred measure, it rose 0.7% for the quarter to put annual underlying inflation at 2.1%. Now, the Reserve Bank generally targets between 2 and 3% for underlying inflation, which means it's back in that range for the first time in several years. Mousina is the senior economist at AMP Capital. Diana, welcome back to Fear and Greed.
Thanks for having me on.
So, what did the data say first up?
I think the best way to look at the figures is to look at the trimmed mean, which is the RBA's preferred measure of inflation. It takes out a lot of the outliers which may happen, so large price rises or large price falls, and that showed an increase of 0.7% in the September quarter. That was higher than expectations, which were centered around 0.5. And as you said, that has now put annual inflation into the RBA's target band. It's now running at 2.1% over the year. That's the highest annual rate of that underlying measure of inflation since 2015. So clearly, we're moving into a higher inflationary environment. That's not necessarily a bad thing. The Reserve Bank in Australia and in a lot of the other parts of the world, the central banks there have been trying to engineer a higher inflation environment over the majority of the last decade, if not even more than that.
Okay, so was the number what you expected or was it higher than what people expected?
The underlying number was higher than what we were expecting. And it really just means that the price pressures that you see in some of the categories for the consumer baskets are quite broad-based. We're now seeing that the supply issues that have come about from COVID, which are putting upward pressure on goods production prices, manufacturing costs, and on global trade, they've now filtered through into prices for furnishings, for household goods, for audio and visual goods, in transport, in housing, in construction costs. So you can see that it's filtering through to a lot of different parts of the consumer basket, which means that price pressures are quite broad. And that is, I suppose, what could be a potential concern for the central banks. They don't want to see inflation getting higher too quickly. They do want to engineer a higher inflation environment, but not to the point where annual inflation is running at well over 3% on a sustained basis. That could cause concerns for central banks.
Okay, so we've spoken a lot in the recent months about whether or not current price rises are transitory or not, more structural. Does this tell us anything about that?
The favourite line of economists at the moment, I think, whether it's transitory or not. It is difficult to say for certain. I mean, COVID has created a huge amount of disruptions and distortions in the data. Consumer demand has lifted significantly over the past year because the government has been trying to supplement incomes in the developed world from COVID disruptions. This has led to higher demand for consumer goods, and this is still continuing. That's filtering through into higher prices. So that's a COVID distortion. The supply issues are also a COVID distortion because a lot of factories are getting closed in countries like China, where they account for a large chunk of global manufacturing and production from COVID outbreaks. And the majority of the increase in demand, I would say, is probably a short-term factor from consumers just feeling very cashed up because they've had a lot of income supplemented to them. That is probably a transitory factor. Some of the supply issues might not be resolved for a number of months, however, because COVID cases are still rising overseas. It's not like the vaccines are reaching 90 or 100% of global population. So you will still see these closures in factories, and that will still continue to put upwards pressure on some of those goods that you need in the supply chain process. So there's definitely some elements that are transitory related to the outbreak, but the increase in consumer demand, I think, is probably here to stay, which might continue to put some upward pressure on those consumer goods prices, at least for the short term. And as well as that, the energy story, higher energy prices, so higher prices for things like oil, natural gas, liquefied natural gas, coal, maybe that's here to stay as well for the medium term because the world is moving away from some of those fossil fuels towards some of those renewables. But I think the infrastructure on renewables might not be strong enough to absorb that higher demand, at least for the short term. So it's probably a bit of both in terms of transitory inflation, but also permanent inflation.
Stay with me, Diana. We'll be back in a minute. I'm speaking to Diana Mousina, Senior Economist at AMP Capital. Last time round, we were talking about some of the rises in childcare, for example, because it was free last time and now people are paying for it. So there's a big increase, but that's actually transitory. That's flow through. The other one was petrol prices, and petrol is expensive. This is referring to what you've just been talking about. Petrol is extremely expensive at the moment. Do they include that in the underlying measure, or is that just seen as something more volatile?
Well, the underlying measure takes out some of the largest price rises and price falls. So while an initial spike in petrol prices may not be included in a specific quarter, if it's a continual rise in prices, which we have seen for oil now for a few quarters, it does eventually get into the underlying measures of inflation. So it will be measured in there, yes.
Okay, so what's all this mean for the Reserve Bank? What do you think they're doing in Martin Place this afternoon, having looked at these numbers?
Probably getting a bit of headache, like me, from looking at all the specific indices in inflation. I mean, the Reserve Bank meeting next week is live in terms of potentially making some changes to their target buying of the April 2024 bond. Now, this is getting a bit technical, but they've been targeting the April 2024 Australian bond to have a yield of 0.1%. They may start to remove that commentary or not target that bond anymore if they eventually want the market to come around to pricing even more interest rate hikes. I mean, the market is already pricing more than one interest rate hike by the end of next year. So next week's meeting could potentially change the commentary around the yield target for the April bond. The broader implication that we see for the Reserve Bank is that interest rate hikes will start sooner than expected. So before, we were expecting that the RBA would increase interest rates probably in the middle of 2023, and we've brought that forward. So we now expect rate hikes to start in November of next year, which is sooner than expected, but in line with market pricing and also in line with the rhetoric from the Federal Reserve, which is the central bank in the US, and in line with some of the other central banks that are becoming a bit more hawkish lately, like the Reserve Bank of New Zealand and the Reserve Bank of Canada, because clearly they can see that some factors in the inflation data recently is probably here to stay, and this period of ultra low interest rates is over.
What you're really saying is that you think rates will rise, the official cash rate, which will flow through to mortgage rates, will rise much sooner than the Reserve Bank said. Once we get that going, November and December, is it likely, assuming the trajectory of the economy, that we'll see a few rate rises over following years to get back to more normal levels?
Generally, that's the way that it works. When the RBA starts hiking interest rates, it's not just one rate hike. They might do 3 or 4 in the period of a year. But mortgage rates are already rising. They're partly priced off what happens to market interest rates, so the government bonds in the short term. The fixed rates across some of the major banks are already rising. But again, we're talking about very small increments. I've seen some banks putting up interest rates by 0.1%. So for the fixed rate. And that's likely to continue over the next year. I think that fixed rates have probably seen their bottom if global interest rates continue to increase as they have over the past few months.
Okay. Now, Diana, you're the perfect person to ask this because you've just had a baby. Congratulations on that. You've just come back to work. But when you left 9 months ago or 12 months ago to the last couple of weeks when you've come back, is the economy very different?
Well, I think that the economy has recovered significantly from the lockdown. I don't think that the lockdowns that we've had in Australia have had much of a negative impact in a macro sense, if you're just talking about it from the whole economy. I mean, of course, some small businesses have gone out of business and people have lost their job. But from a macro perspective, the government has more than supplemented incomes of households who have lost some hours to work or potentially completely lost their job, even though we didn't have the program of JobKeeper in place. So the economy has weathered the lockdowns extremely well. And it also goes to the point that there is this huge amount of pent-up demand from consumers after lockdown. People have been locked down for 4 months, and then afterwards they want to go and spend on services. And their incomes have allowed them to do this during lockdown. If you're fortunate enough not to lose your job, then you probably saved a bit of money. And there is still this huge pile-up of savings for consumers that will allow them to spend now that the economy has reopened. In the US, there are some estimates that consumer savings are worth about 10% of GDP. So in Australia, we could be looking at a similar level here. That's just since the pandemic has started. So I'd say that the economy is in a really good shape overall in Australia to do quite well. And that means that inflation is likely to increase and that eventually the RBA will start hiking interest rates. But a strong economy is something that we should be happy with overall.
Yeah, I'm not really sure whether I'm happy with this conversation or not, Downer, to be honest, because, I have a big mortgage and I like my mortgage rate so low. But in the next few years, I'm going to have to pay more, basically.
Well, that's right, unless you decide to fix a large chunk of your mortgage at a low rate, which a lot of consumers have been doing. There are some estimates that show that for new lending, nearly 50% of that new lending has now been fixed because the rates have just been so competitive and the banks have been slashing the fixed rates over the past few years. A few months ago, you could have gotten a mortgage for 4 years fixed at 1.99%, which is extremely low. So yes, mortgage rates are going to start increasing in Australia over the next few years. But hopefully this also means that the overall environment will be better for consumers in terms of wage rises. Australian wages growth is still very low, running at about 2% per annum. In the US, it's picked up quite significantly. There are some estimates that show annual wages growth running at closer to 4% per annum in the US. So if we do see this high wage environment for consumers, I think that will be a huge positive. That's assuming that inflation doesn't get out of control, though. You don't want to see the situation where inflation's running at a much higher level than wages. That would be negative for consumers.
Okay, Diana, thank you very much for talking to Fear and Greed.
Thank you so much.
That was Diana Mousina, Senior Economist at AMP Capital. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.